Welcome back, traders. It's John. It's September 22nd that I'm recording this video at approximately 9 a.m. Eastern time, but it's based on the closing prices as of September 21st yesterday. As a reminder, I'm an amateur individual growth stock investor. Here's the agenda. We'll talk about the indices, a little bit under the hood, the month of September, trend, the big eight. We'll do an update on those as well as summarize where we're at. So looking at the indices. Last week, we looked at the NASDAQ 100 and we said, even though it was trendless, there was some consolidation in here that had some potential to break out to the upside. So where are we today? This is the same chart of the NASDAQ 100 as of yesterday's close. And you can see here that now we've broken the follow day low, and that was a bad sign. Now we've actually gapped down post Fed meeting, and now we're down in the vicinity of the rally day low. If we officially break the low of the rally day, the rally is officially dead, though for all intensive purposes, it is dead. Now we have a lot of distribution that we've seen over the past couple of weeks. We have net lows accelerating yesterday, and the up-down volume is accelerating below 1.0. These are all really bad signs, obviously, for the index, particularly when that was the leading index. Turning to the S&P 500, you can see here the same chart, a daily chart. You know, we now have this really a head and shoulders top pattern forming, and the S&P now is sitting on this neckline in the 4330 area. Coincidentally, if you take that line all the way across the chart, it corresponds to the August 2022 bear market rally. That's a typo, 2022 bear market rally as a support area. Do we get some support here? It's possible. If we break it, the next area of support is way down around 4,200. So interesting, yesterday it was such a bad, ugly day. You can see all of the ETFs, and I can't remember a day that we saw all of the sector ETFs in the red. Very bad sign across the board. A lot of uncertainty in the market given the Fed comments. Now, that support area, if we were to come down to the top of that support area, that would be about a 9% correction off the top. And there really is nothing support area from where we are to that level. If we go all the way down to the bottom of that support level, it would be about a 12% correction. Now, under the hood, let's take a quick look. Last week, we talked about the advanced decline line and the stocks above the 200-day. We said, well, look, we're holding in there a little bit, and maybe this can actually improve. But the same chart, this is just updated as of yesterday. You know, it's just simply further deterioration, particularly stocks above the 200-day has really plunged down into the 44% level. So rapid deterioration in the S&P in that respect. Now, a couple of things that we might want to be watching is taking the XLY, which is consumer discretionary ETF, and dividing it by consumer staples. We talked about how discretionary was outperforming for the most part of this year. Now, if recession worries are really picking up, this index or this ratio of the two ETFs will roll over. Money will flow into staples and defensive areas, and this will roll over and probably break this trend line. So we want to watch that and see if we hold or we break. Here's another important series of ETFs to keep an eye on. The top is the Russell 2000 ETF, IWM. And this is a chart going all the way back to 2018 to today. And I also paralleled that chart with the XLF, which is the sector ETF for financials. These are correlated. They move fairly similarly. And you can see that we are coming down to some long-term support that came up in these two indexes. You can see they roughly are responding the same way. Now, small caps and financials are a very important element of a bull market. We need to see them in uptrends. So we're coming back down to this major support line, which was resistance way back in 2018 and 2020. And then it's been support throughout 2022 and early 2023. If this industry we want to keep an eye on, because if we get a nice bounce off of this, maybe the corrective phase will be over and we turn back up because we have some long-term support. If this breaks down, this would be a very bad sign. If we break down this long-term support area and we go lower, it gets very concerning that this is going to go a lot deeper. But I keep an eye on it. So let's look at September again. We've talked about it a few times in the past. So I've shown this chart. This is just the seasonality of September. And then more detail showed that it really is the second half of September historically that can be troublesome. And here's the Fed meeting on September 20th. And right on cue, we have started to move lower. It's ironic that this window is right on target, at least in the immediate term. Now, I want to look out a little further. This is a chart from Carson Research, and this is looking at pre-election years in terms of what the market typically does. And the orange line is showing you that typically the market has a fairly strong beginning of the year, as you see in the orange chart, till about July. And then it basically moves sideways until the very end of the year. It usually has another little leg into the year-end close. The green line is 2023 overlaid. And you can see it's correlated pretty well in the sense that we had the banking crisis dip in March. But other than that, we had a very strong uptrend up until about August. And then at August, now we've started to chop around and go sideways. So in many respects, this is acting really normal and according to the script, which would suggest that maybe in October, November, we chop around and maybe there would be a year-end push higher. But according to this particular chart, historically, this is all normal. Now, on the optimistic side, this is another chart from Carson Research. And this is showing a chart of when the S&P is up 10% or more going into September. And it means, and it also brings in when you have a negative August, which we had this year. So you can see all the historical cases of being above 10%, negative August, and what did September do? And what was September through December's returns. And you can see on average, September surprisingly actually came out positive under these particular conditions. And the year-end push was a pretty good push, as we showed. This is actually a median of 8.8%, which would be on the optimistic side to say, can we do that this year based on the data? That would be really more of a positive way of looking at it coming out of the September corrective phase. So monitoring for change of trend, we've been doing this for the past 3-4 weeks. So quick update. The follow-through day that we had is all but dead. We broke the lows. Things look really terrible underneath the surface. So this is really all but dead. Do we have bases and breakouts? No, we actually have charts that are breaking down, and we'll share a few of those in a moment. New highs? No, we're actually accelerating net new lows. No consecutive days above the 20-day. No positive breadth yet. And the volume spikes that we're seeing are not blue. They are actually red, showing more distribution. So it's just really not good across the board. There's no change of trend. If anything, you can say we're establishing a downtrend. So even pilot positions right here seem very dangerous, very ill-advised. We're seeing more deterioration this week. And I've shared before, my experience is when you have an 8 to 12% correction, you really need a new follow-through day. So since this follow-through day has failed, we would need a complete new follow-through day to really reset and ignite a rally attempt. Fed meeting was a couple days ago. They paused as everyone expected, but the comments were hawkish. A couple of highlights from the commentary was the Fed said inflation's too high, and we did see some upticks in some of the September data reports. Job growth slowed, but they emphasized it still remains robust. Not good for bringing down inflation in a steady manner. The Fed's going to continue to reduce its balance sheet and drain liquidity from the market. And they mentioned that economic activity still showed expansion. And expansion really allows consumers to keep feeding the beast of inflation by paying higher prices. So that's not what the Fed really wanted to see. So that comment is hawkish. And basically the message was higher for longer. Maybe there'd be another hike coming if the data really supported it, but this higher for longer really bothered the market, and it turned things into a risk-off environment. Rates rose, stocks sold off as yields are competing with stock for funds. higher for longer might be the new normal for a while. And again, the market didn't like that message. There's still a lot of uncertainty. There's a lot of stuff going on with the auto workers strike. Federal government might shut down. These are all things that are pending that could impact the situation. So the big eight. Last week, we focused on Tesla and Meta. We said they were Tesla was acting well. We wanted to see if it was going to hold the high volume close. And we said Meta was running right into the high volume close. So what do these charts look like today? Well, as of last night, Tesla reversed and rolled over below the high volume close, and Meta met firm resistance at that high volume close, and it's actually broken down lower. Now, who knows? Maybe Meta is going to form a little bottom here and start to trend up and form the right side of a base. That's a possibility. Maybe we plunge lower and break the previous lows in this green line, suggesting that maybe a double bottom base forms. We'll just have to watch it day by day. Now, the other big eight stocks, this is just a quick update. Netflix continues to break down very badly. It's 21% off the July highs. NVIDIA is an interesting one. It's been the leader of the market. It's below its high volume close from earnings. It's really sitting right now around the 1 trillion valuation level at the 409, 410 range. Pretty critical area to hold. Google, which was acting well, was shot down the past 2 days. It's right sitting, will it get some support up the 50-day moving average? Amazon, which was acting well, it's completely broken the last 5 days. It's come off 11% plus. Microsoft, which was forming a base, got turned away at its high volume close, and it's now down almost 8% in only 5 days. Apple, the charts are really a mess. Multiple gaps down within the chart, and then some resistance at high volume closes. So that's a mess. And now remember, the reason we're looking at the big eight is the big eight has a lot of weighting to these indexes, and they have been the big leadership of the market this year. When they roll over, what does that say? Combined with the internals being weak, it's not a good picture. And we've been talking about the big eight really being vulnerable for at least 3 weeks now. So as a summary, again, we mentioned the big eight, they're rolling over. Net new lows is a negative sign. And we're seeing other leaders of the up leg really, really getting shot out of the sky. ELF, CellH, SMCI, and the home builders, which were leading sector, are all breaking down into deeper corrections. And even some of the bases that were promising, Uber, Now, Workday, they're under pressure as well. So I mentioned last week about the Fed. Everybody was pricing in the pause, but I mentioned that it's possible that if the Fed raises interest rates, it could shock the market. And it appears that they didn't even need to raise the rates to shock the market. Just speaking really hawkishly had about the same effect. And it's all about expectation. So there's definitely some readjustment going into the end of the third quarter for portfolio managers. Exposure levels should be very defensive right now, maybe 0 to 10% if you have some cushion. And our quote of the week to wrap up: you can't catch a tan when there is no sun, and you can't catch a trend when there is none. That's from Dave Landry. Well, that's the general market update for September 21st. Let's see how today performs Friday the 22nd, but at the moment, I'd be defensive.